We will now begin our discussion of problem 9-21 on page 411 of the textbook. This problem about Verona Pizza, a neighborhood pizzeria that has a small area for in-store dining as well as it offers takeout and free home delivery services. The pizzeria's owner has determined that the shop has two major cost drivers: the number of pizzas sold and the number of deliveries made. In the book, we're given in the first table a whole bunch of data regarding this pizzeria, fixed cost per month as well as cost per pizza and cost per delivery. In October, the pizzeria budgeted for 1,500 pizzas at an average selling price of $13 a pizza and for 200 deliveries. Data concerning the pizzeria's operations in October appear below. Alright, so we have the actual results. They want us to prepare a flexible budget performance report that shows both activity variances as well as revenue and spending variances for the pizza shop for October. And finally, they want us to explain these variances. Okay, first thing to note with this problem is that this company feels that there are two cost drivers. Obviously, the cost to make pizza, whatever involved there, but also as well as the delivery. They're spending a lot of money to deliver pizzas, and therefore there are certain drivers for certain costs regarding that. Therefore, to get into this, we first take the actual results as given in that second table, and that's pretty much our column all the way to the right. Actual results as given, we just drop those numbers in: 1,600 pizzas, 180 deliveries. And using the formulas that are given in that first table, we have to go through and then calculate, or actually we don't have to. It's given to us. Pizza ingredients or revenue is $21,340. Pizza ingredients $6,850. $5,810 of kitchen staff, utilities, delivery person, delivery vehicle, equipment depreciation, rent, and miscellaneous, all as given. And bottom line is they have $21,340 of revenue. They have $17,991 of expense. Their profit's $3,349. What we have to calculate, I misspoke earlier, is we need to calculate the planning budget, and we also need to calculate the flexible budget. Once we have those two budgets built, we can then calculate the activity variance as well as the revenue and spending variance. Let's work on the planning budget first. Planning budget is based on 1,500 pizzas, 200 deliveries. Using the data given, we calculate our revenue. If we're going to sell 1,500 pizzas at $13 per unit, we'll have revenue of $19,500. Given 1,500 pizzas, using the per unit cost, we'll have ingredients of 6,300, which is 1,500 times 420. We'll have kitchen staff, labor cost of 5,870, which was a fixed cost as given. We will have utility cost. Utilities are a mixed cost, which will be $590 of fixed plus 10 cents per unit. That works out to be $740. The delivery person every pizza we deliver, we have a cost of $2.90. There are 200 pizzas delivered, therefore our pizza delivery person cost is $580. The delivery vehicle is a mixed cost, $610 plus $1.30 per pizza delivered. It's 200 pizzas delivered at $1.30. That would be $260 plus the $610 fixed, $870 of a delivery vehicle cost. Equipment depreciation fixed at $384. Rent is fixed at $1,790. Miscellaneous cost is also mixed, $710 plus 5 cents per pizza. Works out to be $785. All told, our total expense is $17,390. Net income $2,181. At first glance, if you just had the planning budget and you had the actual results, you would see that you performed much better than what would have you planned to do. All right, your profit was $1,200 greater than expected. However, you sold 100 more pizzas. You delivered 20 less. So you really want to know, well, how much of this increased profitability is due to the increased activity or sale of pizzas? How much of it is due to cost or revenue variance? Are we getting more per pizza in revenue? Are we spending more or less in certain expense categories? In order to do this, we must first calculate our flexible budget. What we need to do with the flexible budget is take the actual level of activity, which is 1,600 pizzas, 180 deliveries, and rework the planning budget. When doing so, you end up with a flexible budget profit of $3,130. So, how do we get that? Well, revenue would be 1,600 pizzas multiplied by $13 per pizza, $20,800. Pizza ingredients, 1,600 multiplied by $4.20, $6,720. You see the kitchen staff is still fixed at $5,870, as well as the rent, as well as the equipment depreciation. All of these other formulas are just modified for the 1,600 pizzas. So we end up with, and 180 deliveries. So our utility cost ends up being $590 multiplied by 1,600 times 10 cents. We end up with $750 in utility costs. Our delivery person is $2.90 per pizza, or per delivery, I'm sorry. 290 times 180, we end up with delivery person cost of $522. Our delivery vehicle is $610 multiplied or added to $1.30 per delivery. $1.30 times 180. We therefore end up with $844 of a delivery vehicle cost. Our equipment depreciation is $384, it's fixed, as well as rent, $1790. Our miscellaneous cost is $710 plus 5 cents per pizza sold. We end up with $790 of miscellaneous cost. All told, our flexible budget says that we should, if we sell 1,600 pizzas, have $3,130 of profit. So, the difference between the plan and the flexible budget is primarily due to activity. In other words, we have an additional $1,300 of revenue due to the fact that we sold 100 more pizzas. That is the primary reason for our increased or activity variance, and a primary difference in the overall plan versus actual results. Obviously, if you're going to sell more pizzas, you're going to have to make more pizzas. Therefore, we have some unfavorable expense variances, all right, with ingredients, utilities. However, our delivery person and delivery vehicle, we have some favorable variances. Don't get too excited. This is only due to the fact that we had 20 less pizzas delivered. So you would expect to have less costs for a delivery person and a delivery vehicle. All told, we have a $949 favorable variance, activity variance, between the plan, flexible budget, primarily due to the fact that we sold more pizzas and delivered less pizzas. Now, to look at our revenue and spending variance, which looks at the flexible budget built on 1,600 pizzas sold, 180 deliveries, and we identify any favorable or unfavorable variances in this revenue and spending category that might be due to efficiency. When we look at the two, we notice that our actual results, $21,340 for revenue, we expected only $20,800. We must have been able to charge more revenue, or probably sold pizzas with more toppings than expected, and that was a $540 favorable variance. We had a $130 unfavorable spending variance for pizza ingredients. That would be one item we'd want to look at. What is the cost for that? We had $60 favorable kitchen staff variance. Not sure what that might be. Labor was less hours worked, most likely. Not a huge number. Not certainly worried too much about that. Utility cost, an additional $125 unfavorable cost, unfavorable variance, as well as the delivery vehicle, an additional $138 unfavorable variance. That is, we actually have additional cost more than expected for the delivery vehicle, as well as the utilities. Might be something that would want to be looked into. Overall, we have a $219 favorable variance Revenue and spending variance, not a huge number, but some individual items that may require some attention. Overall, we must be pretty happy. We have almost a $1,200, it's actually $1,168 favorable variance between the plan and actual, and the activity variance and the spending variance do a nice job of identifying why we have a difference between the plan and actual. This does it for our discussion of problem 921.